Welcome to the Pro Ticker Deep Dive.
It's great to be here.
We have a massive session ahead of us. I want everyone to just, take a second and look at the calendar. It's February 2026.
Already.
Already. And if you just take a breath and look around the financial landscape, the air feels distinct.
Distinct is a polite word for it. I'd say it feels heavy.
Heavy is good. Yeah. I mean, remember 2024? Remember even early 2025? It felt like we were at a carnival.
Oh, absolutely. It was all chatbots. Will AI take my job? You have generative art everywhere.
Right, this kind of frothy, speculative excitement where, every company putting AI at the end of their URL got a valuation bump.
A huge bump. It was pure hype.
But now, looking at the data we have in front of us for early 2026, that AI bubble talk, it seems to have vanished.
It hasn't popped. That's the interesting thing. It hasn't popped, but it has settled. It's become something harder.
Harder. More. Industrial.
It has become industrial. That is the key word for this year. Industrial.
Right. It's no longer a toy, it's a factory.
Yeah.
And at the center of this shift is a mystery, or really a detective story, that I want us to unpack today.
I like that. A detective story.
It revolves around one man, one massive fortress of capital, and a strategic pivot that I think explains the entire global economy right now. We are talking about Ken Griffin and Citadel.
The Titan. I mean, if you go by net gains over a career, he is probably the most successful hedge fund manager in history.
And the reason we are talking about him isn't just because he's rich. It's because while retail investors, people like me, maybe even some of you listening, were busy chasing shiny new apps and worried about which chatbot was wittier.
The so-called smart money, led by Griffin, made a violent pivot late last year.
Violent is the word. They stopped betting on who would win the AI war, and they started betting on the battlefield itself.
That is the crucial distinction. If you look at the 13F filings, which we have poured over, and the industry reports coming out of 2025, you see a total change in behavior.
It's a sea change.
It is. It is no longer about picking the winning racehorse. It is about owning the track, the stadium, the concessions, and the very concrete underneath the seats.
So here's the mission for today. We aren't just doing stock picks. That's not what this is about. We are unpacking the industrial AI economy of 2026.
We're going to look at why Citadel is betting that software is about to eat the services sector alive, not just nibble at it, and why owning computing power, specifically NVIDIA and Microsoft, is now, and this is not an exaggeration, equivalent to owning a sovereign nation.
That's a huge statement, owning a sovereign nation.
It's about that level of power and control.
Okay, so before we get into the stocks, the NVIDIAs, the Microsofts, we have to talk about the context. Because the entire hedge fund industry just crossed a massive milestone that really sets the stage for everything Griffin is doing.
Yes, and the headline numbers, as you're about to see, are staggering, but also a little bit of a mirage.
So they're misleading. Let's start there. What's the headline?
The headline is this. The hedge fund industry has officially hit $5.15 trillion in capital.
5 trillion with a T.
A historic high. We have never seen this much money managed by hedge funds. And to add to that, 2025 was the best performance year for the industry since 2009.
Wow. Since the post-financial crisis rebound.
Exactly. The average return was around 12.5%.
Okay, let me play the role of the happy investor here. If you tell me I make 12.5% on my money, I'm usually opening a bottle of wine. Everyone's rich, champagne all around, right? Why is this a problem?
It's a problem of relativity and utility. Because if you dig just a little deeper, there is a crisis of identity happening beneath that enormous pile of money. It's what people are calling the correlation crisis.
Correlation crisis. Okay, that sounds like a math problem.
It is a math problem, and it's a very, very expensive one. In 2025, hedge fund returns hit a 0.92 correlation with the stock market, specifically the MSCI World Index.
Whoa, hold on, walk me through that. A 0.92 correlation, what does that actually mean for my dollar?
It means that for every dollar the stock market moved up or down, the average hedge fund moved 92 cents in the exact same direction.
So they were just moving in lockstep.
In lockstep. Now, if you were an allocator, someone trusting these funds with billions of dollars from a pension or an endowment, you have to ask a very hard question.
Which is?
Why am I paying 2 and 20 fees?
That's the standard fee structure, right? The classic model.
The classic model.
Yeah.
A 2% management fee just for showing up and 20% of the profits.
So why am I paying you this huge fee, this 20% of my upside, if you're just photocopying the S&P 500.
Exactly. Because here is the kicker. Here's the part that really hurts. The S&P 500 did nearly 18% in 2025.
Ouch. So the cheap Vanguard index fund that costs, what, practically zero in fees returned 18%.
And the expensive, supposedly brilliant hedge fund returned 12.5% before taking their huge cut. After fees, the average fund delivered maybe 5 or 6% to the investor.
That is brutal. So the hedge fund was basically just expensive beta?
You nailed it. Beta is just market exposure. You paid a luxury 5-star hotel price for a generic off-the-shelf product.
That's a crisis of value. So
Yeah.
amidst this crisis, the market sort of split, didn't it? Because not everyone was just hugging the index. We saw two distinct camps emerge.
We did. It's a bifurcation, a massive split in philosophy. On one side, you have the concentrated gamblers.
Okay.
These are funds like TCI Fund Management. Chris Hahn over there, he generated $18.9 billion in profit holding just 9 stocks.
9 stocks. 9. That seems incredibly reckless for a fund that size.
It's high conviction, or you could call it high risk, depending on your stomach lining. He's taking these massive, massive swings.
And that's one way to justify your fees, I guess. You're making huge bets nobody else has the guts to make.
Exactly. But on the other side of that split, you have the titans, the pod shops, and this is where Citadel lives, along with Millennium and Point72.
And their game is different. It's completely different. They aren't trying to hit a home run every single time. They aren't betting the farm on 9 stocks.
No, they are selling risk as a product. They offer consistency. They are engineered to survive anything.
Right. And this brings us to Citadel's performance specifically, because their flagship Wellington fund, it did positive 10.2% in 2025.
10.2%.
Okay, hold on. I have to push back here. You just told me the S&P did 18%. You told me TCI did huge numbers with their concentrated bets. Why are we sitting here impressed by Citadel doing 10.2%? That sounds pedestrian.
It sounds pedestrian if you only look at the return column, but that's the mistake. You have to look at the risk column right next to it. Citadel isn't trying to beat the S&P in a straight line during a raging bull market.
They're market neutral, right?
They are market neutral. They are hedged to the teeth. That 10.2% is so impressive because it was achieved with incredibly controlled volatility. It was engineered.
So it's not about the destination, it's about the ride.
It's about surviving the crash. If the market had dropped 20% in 2025, which it very well could have, Citadel likely would have still made money, or at least stayed flat. The S&P would have crushed you.
Okay, I see. So that 10.2% is the fee you pay for sleeping well at night.
Exactly. They weren't just riding the wave, they were building a seawall and surfing at the same time.
And 2025, let's be honest, it wasn't all smooth sailing, was it? We tend to forget now, in February 2026, but there were moments of real terror in the market.
Oh, yes. The great DeepSeek panic of January 2025.
I remember the headlines, but remind us of the details, because that felt like the moment the entire AI narrative just cracked for a second.
It did. It was a very specific week in January. DeepSeek, a Chinese AI lab, released a model that was, well, it was terrifyingly efficient.
Efficient.
It wasn't just that it was smart, it was that it was incredibly cheap to run.
Cheap to run, and why did that scare the market? I would think cheap AI is a good thing.
It's good for users, sure, but it's terrible for the shovel sellers. The market looked at DeepSeek, and the immediate thought was, wait a minute, if we can run powerful AI on a toaster, maybe we don't need to buy $50 billion worth of NVIDIA chips every quarter.
I see. The fear was that efficiency would completely kill the demand for all this expensive new hardware.
Exactly. The fear was that the moat around NVIDIA was gone. DeepSeek used a technique called mixture of experts and this intense distillation process to get world-class results with a fraction of the compute power.
So NVIDIA stock just got hammered.
It took a massive hit. The whole narrative shifted overnight to the AI CapEx boom is over.
Yeah, it was panic.
And what did Ken Griffin do? Did he panic? Did he sell?
He did the absolute opposite. He recognized something called the Jevons paradox.
Jevons paradox. Okay, dust off the economics textbook for me. What is that?
It's this counterintuitive idea that as technology increases the efficiency with which a resource is used, the total consumption of that resource actually increases rather than decreases.
Give me an example. The classic one is coal. When steam engines got more efficient, England didn't use less coal. They used vastly more coal because it was now economical to put steam engines in everything.
Or like driving. If you make cars more fuel efficient, people don't just drive the same amount and save money. They drive more because it's cheaper per mile.
Precisely. So Griffin applied that. He bet that if AI gets cheaper to run, we're not going to run the same amount. We are going to run 1 billion times more of it.
So he realized that efficiency just lowers the barrier to entry, which invites more demand, which fills up the data centers even faster.
Yes. So while the rest of the market was dumping NVIDIA in January 2025, thinking the party was over, Citadel was buying. They used that panic to load the boat.
That brings us perfectly to the big bet, the return to infrastructure. Because looking at the filings, Griffin's relationship with NVIDIA was, well, it was complicated in 2025.
It was a roller coaster.
Yeah.
It really was. If you look at Citadel's filings in early 2025, even before the panic, they actually slashed their NVIDIA stake.
They did.
They cut it by half.
So they sold. Right when everyone else was screaming, buy NVIDIA, Ken Griffin was selling.
He was. And the reasoning at the time, which seemed pretty sound, was the complexity concern.
What's that?
The idea was that deploying these massive AI systems was getting too hard, too complex. Companies were buying billions in chips but couldn't figure out how to wire them up, how to cool them down, how to write the software to run them efficiently.
So there was a fear of an air pocket in demand, that customers would just pause buying to digest what they already had.
Exactly. I mean, you heard stories about pallets of GPUs just sitting in warehouses because nobody could build the data centers fast enough to house them. It felt like maybe the hype had outpaced the physical reality of deployment.
Right. But then the twist.
Then the twist. In the third and fourth quarters of 2025, after the DeepSeek panic had subsided and this new reality set in, Citadel came roaring back.
And they didn't just buy back what they sold.
No. They went bigger, much bigger. In Q4 2025 alone, they increased their NVIDIA position by nearly 120%.
120%. In a single quarter. That isn't a tweak. That's a violent rotation.
It's a violent high-conviction move. They added about 11.7 million shares. NVIDIA is now Ken Griffin's largest single equity holding.
And how big is that position now?
We're talking about a position worth over $4 billion.
Wow. Okay, so why the flip-flop? Aside from the Jevons paradox, what changed in Griffin's mind regarding that complexity problem?
He realized that the complexity wasn't a bug. It was a feature.
How so?
It was a moat.
How is complexity a moat? Usually you want things to be simple so people buy them.
In consumer goods, yes. In enterprise infrastructure, complexity is lock-in. It's stickiness.
Explain that.
Think about it. If it was easy to switch from an NVIDIA chip to a competitor from AMD or Intel, people would do it constantly to save money. The market would be a race to the bottom on price.
But it's not easy.
It's incredibly difficult. It's not just the chips. It's the entire ecosystem. It's one word. CUDA.
CUDA. We hear that acronym a lot. That's the software layer that NVIDIA uses, right?
Think of CUDA as the operating system for the GPU. Over the last 15 years, millions of developers, researchers, and data scientists have written their code specifically to talk to CUDA. It's a language, a standard.
So if you're a company and you want to switch to an AMD chip,
You can't just plug it in. You have to rewrite the very foundation of your code. You have to retrain your entire workforce. It would take years and cost a fortune.
so NVIDIA trapped the developers.
They trap the entire industry.
Yeah.
The complexity means that once you have built your data center around NVIDIA's architecture, the cooling systems, the networking, the software, you're married to it.
And divorce is too expensive.
Prohibitively expensive. Griffin realized that the very difficulty of these systems meant that NVIDIA's customers had no choice but to keep buying NVIDIA's next chip and the one after that.
So the fact that it's so hard to use actually protects NVIDIA's dominance. That is a cynical but brilliant insight.
And then you add the sheer industrial scale of the spending. The hyperscalers, Amazon, Microsoft, Google, they aren't stopping. They are pouring hundreds of billions of dollars into data centers.
So Griffin realized you just don't bet against the company selling the bricks for the fortress.
Especially when they are the only company whose bricks fit the blueprint that everyone is already using.
So Citadel is the fortress. Ken Griffin is the commander. He buys the dip on NVIDIA. But NVIDIA, as powerful as it is just the hardware. It's the engine.
It's the pick and shovels.
Right.
Yeah.
But you also need an operating system for this new economy. And that brings us to the second pillar of Griffin's massive bet.
Microsoft.
Microsoft.
The giant. The quiet giant that just keeps growing.
Now, everyone owns Microsoft. I mean, it's like owning air. If you have a 401k, you own a piece of Microsoft. But Citadel's buying pattern here was very specific, wasn't it?
It was. It was very aggressive. They bought heavily in Q2 and Q3 of 2025. The stake crossed $2 billion at its peak.
$2 billion.
Now, they did a little tactical trimming in Q4, which was mostly for risk management, which we can discuss later. But the core thesis remains huge. And it's different from the NVIDIA thesis. This isn't just about hardware infrastructure.
No, this is about something else. This isn't just because we all use Word and Excel. This is about a concept called agentic AI.
Yes. If you take one thing away from our deep dive today, let it be this term, agentic AI.
Okay, let's break that down because I feel like agent is the buzzword of 2026. We've had chatbots for a few years now. I asked ChatGPT a question, it gives me an answer. What is an agent? What's the difference?
The distinction is one word, action. A chatbot talks. An agent does.
Okay, give me a concrete example. Make it real for me.
All right, let's take a common business task, booking a corporate retreat. In 2024, if you wanted to do that, you might use a chatbot. You'd ask it for hotel recommendations in Miami,
And it would give me a list.
a list. Then you, the human, would have to go to Expedia, check the availability, find the company credit card, enter all the details, email your boss to get approval, and then forward the receipt to the accounting department.
Right. The chatbot is just a fancy search engine. I'm still doing all the actual work.
Exactly. An agent is different. An agent is a game changer. You give the agent permission to access your calendar, your email, the company credit card API, and the corporate travel policy.
So you give it the keys.
You give it the keys, and then you just say, book a retreat for the marketing team in Miami for under $5,000, and then you walk away.
And the agent.
The agent negotiates the rate with the hotel's AI, it books the rooms, it puts the event on everyone's calendar, it sends the invites, and it automatically files the expense report with accounting.
It actually executes the transaction from end to end.
It executes. So moving beyond chatbots to agents means moving from software that helps you work to software that is the worker.
That sounds remarkably profitable for the company selling the software and remarkably ominous for the person who used to do that booking.
That is the Robert Smith and Vista equity thesis, which Griffin seems to wholeheartedly subscribe to. AI isn't just a tool to help workers anymore. It creates autonomous software workers.
And this leads to the most important metric for Microsoft, pricing power.
Unbelievable pricing power.
How much can they charge for this?
Well, look at what's happening right now in early 2026. Microsoft is raising prices on its commercial subscriptions by as much as 33%.
33% in a low inflation economy. That seems incredibly aggressive. How do they get away with that without customers revolting and leaving?
Because the value proposition has fundamentally changed. They aren't just selling you a slightly better word processor anymore. They are capturing the salary of human workers.
Unpack that math for me. That's a huge claim.
Okay, let's say you have an administrative assistant that you pay $60,000 a year. Their job involves a lot of scheduling, booking, and expense reporting.
A very common white-collar job.
Very common. Microsoft comes along and says, we have an agent that can do 80% of that assistant's scheduling and booking work. We're going to charge you an extra $200 a month for it.
So that's $2,400 a year.
$2,400 a year versus a $60,000 salary. It's not even a question. Even if Microsoft doubles the price to $400 a month, it is still a massive steal compared to the human salary.
So they are effectively transferring the value from the labor market directly to the software license?
That is why they have pricing power. That is why Ken Griffin sees them as the default platform for the entire enterprise world.
That is the aha moment. They are literally capturing the labor market's value. Griffin sees that software is about to eat services.
And he wants to own the mouth that does the eating.
But here's the flip side of that coin. Capital isn't infinite, even for Ken Griffin. To fund these massive buys in Microsoft and NVIDIA, Citadel had to sell something. And what they sold is really telling about their view on hype versus reality. They dumped Palantir.
This is the contrast trade. And it is absolutely fascinating. Citadel dumped about 48% of their Palantir stake. Some data points suggest they sold even more, up to 91%, depending on the specific filing window you look at.
Palantir, I mean, that's the darling of the retail investor community, the AI pure play. They have the boot camps, the cool CEO, the secretive government contracts. Why on earth would you dump it?
It comes down to a choice. Speculative application versus owned infrastructure.
Okay, distinguish those for me.
Palantir is an application layer. It sits on top of the stack. It's brilliant software, don't get me wrong. But it is seen by the smart money as expensive hype relative to its actual earnings.
It's a bespoke solution.
It relies on selling a specific outcome to a specific client, Microsoft and NVIDIA. They own the plumbing. They own the foundation that Palantir has to build on top of.
So, to use an analogy, Palantir is the flashy, custom-built race car.
But NVIDIA is the road it drives on, and Microsoft provides the traffic laws and the gas stations for the entire economy.
Exactly. And in 2026, with that speculative bubble settling, Griffin wants to own the road. He wants to own the toll booth. He doesn't want to bet on which car is going to win the race.
He wants to charge every single car that drives by. Palantir is a bet on a specific winner in a very competitive race. Microsoft is a bet on the entire economy continuing to function.
That makes perfect sense. It's a flight to quality, a flight to durability.
Durability, that is the word.
Now, we've talked about the two giants, NVIDIA and Microsoft, but there is a sleeper in the portfolio, a company that Griffin specifically called a long-term compounder.
Yes.
And he made a very strange, very powerful comparison. He compared its computational power to a country,
Alphabet. Google.
Google, the company everyone loves to say is falling behind, the one that's getting disrupted.
The market loves to hate Google. They say their search is dying, that Perplexity is killing them, that OpenAI is killing them. But Griffin, he's not listening to that. He calls Alphabet a long-term compounder and compares their compute power to the fifth largest country in the world.
The fifth largest country, that is an insane scale. What does that mean in practical terms for an investor?
It means sovereignty. We keep using that word, but it's the right one. Nation-state power. Griffin is making a value play here. He thinks the market dramatically underestimates Google's infrastructure.
How so?
While everyone else is fighting and scrambling for NVIDIA chips, paying whatever Jensen Huang asks, Google has been quietly building their own for a decade.
The TPUs, their tensor processing units.
Correct. Google has its own custom-built silicon. They have their own software frameworks, TensorFlow. They have their own global network of data centers. Citadel increased its stakes in both Class A and Class C shares of Alphabet.
So while everyone is anointing Microsoft as the winner of the AI wars, Griffin is saying, do not count out the empire of Google.
He's saying that Google controls its own destiny in a way that almost no other company does. They don't have to pay the NVIDIA tax if they don't want to.
That's a huge advantage.
It protects their margins. If NVIDIA decides to squeeze everyone on price next year, Google's the one company that can credibly say, no thanks, we'll just use our own. That is a massive strategic advantage that he believes the market wasn't pricing in.
That's smart. It's almost a hedge against the NVIDIA monopoly in a way.
It absolutely is.
Okay, now let's get really sci-fi for a second. Let's look further out. Because Citadel isn't just looking at 2026, they are looking at 2030 and beyond. And they made some bets that are, frankly, they're mind-bending. They bought into quantum computing.
This is the frontier bet. It's a tiny slice of the portfolio, but it's hugely significant. Citadel took stakes in Rigetti Computing and D-Wave Quantum.
These are small positions relative to NVIDIA, right? We aren't talking about billions of dollars here.
Oh no, these are tiny, almost rounding errors in the context of a multi-hundred-billion-dollar fund. But they are incredibly significant signals. You don't buy these stocks for next quarter's earnings.
So why do you buy them?
You buy them as a hedge against the end of Moore's Law.
Moore's Law, the idea that computer chips get twice as powerful every 2 years or so. We've been riding that wave for 50 years. Are we really hitting the wall?
We are hitting the limits of physics. Literally, we are shrinking transistors down to the size of a few atoms. When you get that small, you have problems with heat. You have problems with something called quantum tunneling.
What's that?
It's where electrons just jump through the gates because they're so thin, they teleport. You can't just keep shrinking silicon forever. The laws of physics get in the way.
So if traditional chips hit a wall, if NVIDIA hits a wall, what happens to this whole industrial AI economy we're talking about? It just stops growing.
Unless you change the physics. Unless you change the entire paradigm of computing. Unless you go quantum.
So quantum is the escape hatch.
Quantum is the only way out that we can currently conceive of. If silicon fails to keep up with the exponential demand for AI models, quantum computers are the only theoretical architecture that can handle that level of complexity.
And Griffin is betting on two different approaches here with Rigetti and D-Wave. What's the difference between them?
It's a classic spread bet on an emerging technology. Rigetti is trying to build the universal gate-based quantum computer. They're trying to build the whole stack, the chips, the supercooled fridge to house them, the software. It's the holy grail, but it's incredibly, incredibly hard.
And D-Wave, they're doing something different.
D-Wave is focused on a more specialized approach called quantum annealing. It's a specific type of quantum computing designed for optimization problems. Think, what is the most efficient route for 10,000 delivery trucks in a city? Or what's the optimal way to design a new drug molecule?
So it's a spread bet, one on the general purpose future, one on a more near-term specialized application.
Exactly. He's saying, I don't know which one will work, or if any will work in the next decade, but if the Silicon Party ends, I need a ticket to the quantum lifeboat. It's insurance,
It's insurance against the obsolescence of his biggest holding.
which is fascinating. He's hedging his NVIDIA bet with the very thing that might one day destroy NVIDIA.
That is the definition of a hedge fund.
That's the game.
Speaking of hedge funds, we need to talk about how the sausage is actually made here. We've been talking about buying stocks long NVIDIA, long Microsoft, but Citadel's a pod shop. They don't just buy stocks and hope they go up. That's what I do. That's not what Ken Griffin does.
No. If you just bought stocks, you'd be a mutual fund. Citadel is a hedge fund. The hedge is the most important part of the name, and this is where we get into the mechanics of the machine.
I saw a number in the filings that just shocked me. 81% of the portfolio's market value is often in options and other derivatives. 81%.
That is the market-neutral machine at work, and it's what separates them from almost everyone else.
Explain that to me like I'm 5. Why so many options? What are they doing with them?
It's about isolating variables. Think of it this way. If you just go out and buy NVIDIA stock, you are making two bets at the same time.
Okay, what are they?
One, you're betting that NVIDIA is a good company with a bright future. And two, you're betting that the stock market generally goes up.
Right, because if the whole market crashes, NVIDIA's going to crash too, even if they're selling a lot of chips.
Exactly. Griffin doesn't want to make that second bet. He thinks the market is mostly efficient and very hard to predict. He only wants to bet on NVIDIA relative to everything else. So for every dollar they have in a stock like NVIDIA, they have these sophisticated derivative structures built around it to cancel out the market noise.
And this is where the center book comes in. I've heard this term whispered with a lot of reverence in financial circles. What is the center book?
Think of the center book as the central nervous system of the entire firm. Citadel has something like 185 independent trading teams, or pods.
180?
And they are all out there doing their own thing, making their own bets. But the center book sits above them all. It's this central risk management desk that looks at the aggregate risk of the entire firm.
It's the eye in the sky.
It's the eye in the sky. And if the center book's algorithm flashes red and says, whoa, we have way too much exposure to the tech sector right now, they don't necessarily call up the pods and tell them to sell their stocks.
What do they do instead?
Instead, the center book goes out into the market and buys massive puts.
Puts, which are bets that the price of something will drop.
Huge puts on the S&P 500, specifically the SPY ETF and the NASDAQ, the QQQ ETF.
So let me get this straight. They are betting on NVIDIA to go up, but at the same time, they're betting on the NASDAQ to go down. That seems contradictory.
It's not. They are stripping away the macro risk.
Yeah.
The beautiful piece of engineering. If the whole market crashes, their puts on the QQQ make a fortune, which can offset the loss on their NVIDIA stock.
If the market rallies?
If the market rallies, their NVIDIA stock makes money, which pays for the cost of the puts they bought.
So they only win if NVIDIA outperforms the market, regardless of which direction the overall market goes.
That is the entire goal. It is to engineer the outcome. They want alpha, which is the skill of the stock pick, without the beta, which is just the random drift of the market.
Now, you mentioned the pods, 185 teams. I've heard the culture there is, well, intense.
Intense is putting it lightly. It's famously ruthless. Think of it like a submarine with watertight
A
compartments.
submarine.
Yes, each pod is one of those compartments. They are given a certain amount of capital to manage and a very, very strict set of rules. They're called drawdown limits.
And what happens if they hit that limit, if they lose too much money?
If a pod loses, say, 3% or 5% of their capital in a given month, the doors slam shut, the capital is pulled instantly, the portfolio manager is often fired on the spot.
Just like that. One bad month and you're out.
Just like that. The philosophy is that the ship doesn't sink just because one compartment floods. They seal it off, eject the team, and bring in a new one to take their place. It protects the firm from a catastrophic failure, but it creates an unbelievable amount of pressure on those teams. It's survival of the fittest on a monthly, sometimes weekly basis.
And in 2026, survival is the name of the game, because the risks in the system right now are, well, they're terrifying. We are painting this rosy picture of Griffin's genius, but the system is flashing red in some very important areas.
It really is.
Let's talk about those risks, because nothing is risk-free. What keeps a guy like Ken Griffin up at night?
Number one has to be leverage. The industry is at the 99th percentile of historical leverage.
The 99th percentile. So that means they're borrowing more money to make these bets than at almost any other time in history.
Yes, they are levered up to the eyeballs to try and squeeze out those returns in a competitive environment. And when you combine very high leverage with the second risk, crowding, you get a powder keg.
Crowding, meaning everyone is in the same trade.
Everyone is in NVIDIA. Everyone is in Microsoft. If you look at the ownership data, it's all the same funds. Citadel, Millennium, Point72, TCI. They're all sitting in the same theater, watching the same movie.
So if someone yells fire,
If the tech trade breaks, say, NVIDIA misses earnings by just 1%, and everyone rushes for the exit at the exact same time, well, the door isn't big enough.
a stampede.
It's a stampede. That is correlation risk. It becomes systemic. Prices can gap down 20% in a matter of minutes because there are no buyers left. Only leveraged sellers getting margin called by their prime brokers.
That is a very scary visual. A stampede in a dark room where everyone is over-leveraged.
This is why Griffin trims his winners. Remember we mentioned they trimmed that Microsoft position slightly in Q4?
Yeah, I was wondering about that.
He isn't losing faith in Microsoft's future. He is rebalancing the risk. He sees the crowding in the theater. He is taking some chips off the table to make sure that if the fire alarm gets pulled, he isn't the one getting trampled. He's standing near the exit.
That is the discipline. It's not about falling in love with a stock. It's about managing the exposure at all times.
Exactly. The smart money playbook isn't just buy low, sell high. It's buy the infrastructure, hedge the macro, and never, ever, ever run out of cash.
So bringing this all home, 2026,
Okay.
the year of industrial AI.
Industrial AI, hard hats and servers.
If we summarize the Ken Griffin playbook for this new era, it seems to be own the infrastructure, that's NVIDIA. Own the enterprise platform, that's Microsoft. Hedge the macro risk with SPY and QQQ puts. And ignore the speculative hype apps like Palantir.
Don't chase the shiny object. Chase the shovel seller. And more importantly, chase the company that owns the land where all the digging is happening.
So for our listener, the learner tuning in today, what is this? So why should they care about the portfolio moves of a billionaire?
Because it tells you where the economy is going before it gets there. Don't just chase returns. Look at durability. If the biggest, most sophisticated money in the world is betting that software is about to replace human services, this agentic AI concept we talked about, you need to think about your own exposure.
Your own career exposure, you mean?
Absolutely. Are you in a service role that software can eat? Is your job booking the travel? Or are you learning how to build the agent that books the travel? It's a fundamental question everyone needs to ask themselves.
That leads us to our final provocative thought for the day. And this one kept me up last night after I was reading through all this material. It's the real elephant in the room.
It's the macroeconomic paradox of it all.
We talked about the $5 trillion industry. We talked about these massive, brilliant bets on AI infrastructure. But consider this. If agentic AI really does start eating services, as Griffin and the entire market seem to believe, if Microsoft can raise its prices by 33% because they are effectively replacing human salaries.
The question is, who is left to buy the products?
Exactly. The economy is a circle, right? I work, I get paid a salary, I use that salary to buy stuff. If the software does the work, the corporation gets the profit, and the shareholder gets rich. But the software doesn't buy cars, the software doesn't buy houses, the software doesn't go on vacation to Miami.
The consumer economy is 70% of GDP in the U.S. If you automate the consumer class out of a job, and therefore out of an income, who are you selling all your efficiently produced goods and services to?
That is the paradox of the agentic future. We are building a machine that is incredibly efficient at producing value, but we might be simultaneously destroying the mechanism that consumes that value.
And that is a systemic risk that no amount of SPY puts can hedge against. That isn't a market cycle. That is a structural rewrite of capitalism itself.
Well, on that cheery note, this has been the Pro Ticker Deep Dive. We've unpacked Citadel, NVIDIA, and the potential end of the white-collar labor market.
It's a light Tuesday discussion.
Exactly. Thank you for listening. Keep looking at the infrastructure, not just the hype. We'll catch you on the next Deep Dive.